With foreign investors showing just a flick of interest in Kenyan equities over the recent past, activity has been pretty low. So what's it going to take, in your opinion, to get things moving from that end again? Because it's not just domestic issues that we have to contend with here. Regional issues come to play where distinguishing between geographies, it seems, has come to elude many foreign investors.
I think you're very right, and I think we can see what's happened essentially since the beginning of the year, where we've had these tremendous tumbles in the Maghreb, the North African markets. Tunisia is down 21%, Egypt opens tomorrow down 21%, and most of the fund managers, the foreign fund managers I meet, seem to take a more sort of a continent-wide view. And I think that's not helping places like East Africa right now, because I think they're rather caught, they're like rabbits caught in the headlights of North Africa, and therefore have become sidelined here in Nairobi. So I think it really requires something beyond our control, which is some settling down in North Africa before we see that renewed appetite. And I'm not sure it's going to settle down in North Africa. I think it's moved to new normal, and if anything, it's going to spill over into Saudi Arabia.
Well, we'll of course be watching developments as they unfold on those ends pretty keenly. In the meantime, we've had a slew of company reports hitting the markets, and that keeping domestic investors at least pretty busy. Bamburi amongst the latest, and we saw a 21% drop in annual pre-tax profit there. Run us through what you've made of that, because we were speaking to Wanjohi a little earlier, and he was saying this is a company that just didn't anticipate the kind of competition that would hit them. But some would say pretty surprising, because it had been there all along, hasn't it?
Well, I think obviously it's a much more competitive environment. Athi River Mining is a very, very fierce competitor. There have been some new Indian entrants as well who've put the pressure on. But, you know, when you look at those Bamburi full year results, you've got to bear in mind that in the previous full year, they booked an extraordinary one-off gain of about 1.2 billion shillings. If you strip that one-off gain out, the year-on-year is about minus 5%. So it's less, it doesn't look as bad once you strip that number out. So I think on balance, I don't think, you know, they're waving the white flag. I think it's a little bit of disappointment, but the disappointment should not be as deep as some people are making it.
Yeah. Oh, how did it compare to East African Portland Cement? How does the company compare right now? Because we saw that company posting a 41% fall in first half pre-tax profit as a result of rising costs. That rising 18% compared to revenue growth of 8%.
East African Portland is a very tricky and curious cement company to analyze. These results that they recently delivered were flattered very much by a one-off tax gain that they took of about 527 million. If you took that one-off tax gain out, the underlying operations do not look as robust as they might do if you just looked at the EPS. You know, they've got a lot of moving parts. They've got a yen loan which keeps on impacting the balance sheet, but they look to me as if they're looking to re-engineer themselves. I think they're going to put on some coal capacity in the next 12 months, and that should bring down their costs quite dramatically. For me, I'm sidelined until I see a little bit more clarity in that balance sheet.
Talking about the road that they're venturing down in striving to bring down their costs in terms of commissioning this coal-firing facility moving forward. How does that come to bear on a player like Kenya Power and Lighting on Friday, also posting a 7.5% rise in first half pre-tax profit? But as players like East African Portland Cement commission their own coal-firing facilities, one would assume that this would be a threat for a player like KPLC.
That's a good point, and I think, you know, Kenya Power cannot assume that everybody's going to sit on the sidelines and wait for the day that they put on the extra capacity. And as you're saying, the likes of Portland and many other corporates are really looking to sort of own their own destiny. And over the medium term, that causes a problem for the likes of Kenya Power, because these people will no longer draw on their power requirements from Kenya Power. Kenya Power, the profit report was up 7.5%. It wasn't that spectacular, But really, it's a story. They've got the rights issue money in, which was just over $100 million. And Kenya Power now is all about execution. It's not rocket science. They've got to add the capacity. They've got to do it at a good rate. And if they can do that, then I think 18 months down the road, it looks a very interesting share. At the moment, it's on a trailing price earnings of about 11, implied from that 6 months. And it doesn't look as much a no-brainer as some people make it out to be.
Where, KCB comes to the forefront. I mean, it's pretty different in that case. I mean, pretty much looking as a no-brainer there, exceeding market expectations with a 56% jump in profit. And what stood out is that it managed to increase its non-interest income and loans in 2010. So let's go through the main drivers on that front and just how sustainable that kind of growth is.
Well, I think, they're accelerating at this point in time. If you take it quarter on quarter, the acceleration continues to gain traction. They went first with their rights issue in the middle of last year. They bagged the cash. And I think what you're seeing is the multiplier effect of that rights issue money on their balance sheet. I don't think it slows down yet. I think there's more momentum. And on a price earnings of 8.33 or thereabouts, with this fantastic regional franchise, which goes from southern Sudan to Tanzania to Uganda to Rwanda, they've got a very good franchise in the mortgage business. I think it still looks a cheap share, and I think it will continue to gain momentum. And I see the price considerably higher, at least about 40 to 50% actually.
So Aly Khan, where we had that struggling Rwandan and Tanzanian unit, and the question arising from that, is expansion possibly happening too fast? I mean, looking at it now with that cost-to-income ratio down to 63 from 69, has that brought along with it some optimism on that front and some renewed vigor and possibly buy-in from investors as KCB continues on this aggressive regional expansion?
I think investors have still got a little bit of, they're still applying a haircut on KCB's expansion plans, which I think will start coming off over the next 12 months. They've hired McKinsey to look at their cost base. They've taken 700 basis points, as you note, off the cost-income ratio. And I think there's a lot of fat on this balance sheet that they can trim. And I, for one, think investors are going to gradually begin to appreciate this story in a way that they have not appreciated it so far. That's why it's on this low price earnings, and that's why I expect a re-rating.
Well, there's also an issue that needs to be cleared up, and that's the profile of the bank's loan book, which grew by 21% in 2010. Has the market received any clarity on the profile of that loan book and just how sustainable that is?
Well, I've heard this question before. I'm not so sure there's an issue around that profile. I think, for example, they've been expanding the mortgage lending book. And mortgage lending is hardly rocket science. You can look at what prices they've got involved at, the types of ratios they're lending at. I, for one, am not concerned that at this point in the cycle that they're entering into bad risk-adjusted lending. I think they're just expanding that balance sheet. They got liquefied, they got cash to give their customers, and they've gone after those customers more aggressively than they have before.